Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's April 26th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Guys, I'm not sure you know this yet, and this is proprietary information. It's extremely valuable. I ask you to do me a favor, and please keep it to yourself. But the 10-year is at 3%. I'm not sure if you knew that. Not sure. Even though CNBC, Bloomberg, Fox Business have mentioned this every single minute over the past 2 days. When the 10-year was at 2.99, that's fine. No need to worry. But 3%, holy cow. Sell your house, call your broker, sell everything. And whatever you do, don't keep your money in the bank. Because I read ATMs are going to no longer work. So get a bunker, put your family in it. Sure to buy enough dog food. Because most people in the bunker industry say it's the biggest mistake they see, forgetting to pack enough dog food. If you need to buy a bunker, they cost around $25,000. I'm not kidding. Atlas Survivor Shelters. You enter the promo code, I need a freaking shelter right away. And you'll get 10% off. I already called them. Done deal. Before you buy your bunker, there's just a few things you should know. Since the 10-year hit 3% over the past 2 days, look at the market. All the emotions, all the risks you have to worry about, the crazy reporting, the nervousness, it's down 2%. It's not down 10%, like the financial media wants you to believe. Remember, fear sells. They want you to be paranoid, scared to death, because then you're going to stay home and read everything they publish. That's how they make money. But let's take a step back here. Because what do we know? Interest rates are rising, right? Again, everybody knows that's no surprise. But what exactly does this mean? Now, the 10-year is used to set mortgage rates. So as that goes higher, that makes borrowing costs go higher, and that could slow home sales. Higher rates also result in higher borrowing costs for companies. That's less money to buy back their stock, acquire companies, expand. Things that we like, CapEx in the business. But there are so many positives. And you can look at the record $5.4 trillion in equity and home equity, right? People have in their homes. Nobody's really talking about. There's no supply in the market right now. You look at higher interest rates, that really sucks for companies who are leveraged. Yeah, it's hard to borrow. What about the companies that have huge cash piles on their balance sheets? That's pretty good news if you're Apple, right? You're sitting with, over $200 billion in cash, and that includes the cash that came back from repatriation, stuff like that. That's pretty cool. Interest rates are going higher. Microsoft, $140 billion in cash. Cisco, $70 billion in cash. Alphabet, $100 billion in cash. Could be making more money on that. We're looking at a market where earnings are growing 19% year over year. Probably can't remember the last time they grew that fast. You have to go back a long time. Without tax reforms, we're growing at 15% year over year. Still a remarkable and incredible number. And you hear the argument out there, especially when I like to watch CNBC just to see me a better gauge of what's going on out there. With the emails that I'm probably going to get of the worries, because what they're saying on CNBC, on Bloomberg, in different outlets. Not that I don't like them or like the people on them, but that's the way it is. A lot of things are hyped up. But what they're arguing is during earnings season. They say, yeah, but Frank, companies like Twitter, Boeing, they're crushing earnings. Those stocks are selling off. That's a bad sign. It's a horrible sign. Actually, it's not. It's the same thing that took place the last two earnings seasons. I covered this already. Companies that beat saw their stock decline. The last 2 quarters, it's happening. The same thing today. Now, what happened? Yeah, those stocks declined, but they really rose sharply after those earnings seasons ended. More money got pushed into these names. Institutions started buying, and they started taking off and gained momentum. Actually hit new highs. Then we had what? In January, a little bit into February, we had a 10% decline. People worried about tariffs. I told you to worry about it. It's not going to be a story. It's no longer a story, right? It's nowhere. It was the end of the world. Right now, China's meeting us. Everybody's okay with it because when you go over the facts, everybody's robbing us. And, again, I'm not going to cover this and get into all this stuff again, but between having a surplus, when you have a surplus, you don't want to be in a trade war. It's the worst thing ever, which the EU and China, that's why they're fighting us so much, but they're going to come to terms with us. They have to. They have no choice. And they did, and they are behind the scenes. And now it's no longer a story. So what happened? The markets came back. But now we have this magical 3% on a 10-year. And I'm not sure who drew that line in the sand. Because again, it's not 2.98. We're okay. 2.99. 3% run to the hills. Just think about that for a minute. You see that. It's like, jump out your window. It's crazy. It's just insane. The news out there. It's nuts. I mean, if you look at the facts again, right? Let's look back at the 10-year and go back, let's say 10 years pre-2008, right? We all know 2008 was a credit crisis. What happened? We won't cover that. During that 10-year stretch, I don't know if you know this, but the 10-year averaged well over 4% leading up to the credit crisis. We were kind of fine until the you-know-what hit the fan. People got a little crazy in 5, 6, 7 with housing and synthetic CDOs on top of synthetic, whatever. You know what happened? People got greedy. But I'd argue right now, stocks, not even argue, it's true. Stocks are cheaper and growing faster today compared to then. In 2010, 2011, after the credit crisis, 10-year average 3.5%. We were fine. We didn't have people going on TV saying, if it hits 3%, that's it. Sell everything. We didn't have that back then. Turned out to be fine. And yes, rates declined since then. But look at the Fed. Even if they decide to raise short-term rates another 3 times, right? So for the rest of the year, it would be 3 more times, and they're raising at 25 basis point clip, right? So if they have 3 more hikes by the end of 2018, we're still going to be well below the historical average. Does that mean you should go in and buy every single stock? No, I'm not saying that. But be smart. And when everyone else is panicking, when the market's just down 2% because a number hit something that was a line in the sand at 3%, that's it, it's over. Use it to your advantage. Look to buy Boeing down 20% off its highs. It just reported a blockbuster quarter, record numbers, record on top of record on top of record numbers, last 3 quarters for Boeing. And the stock's down 20%. Look to buy Twitter. That was up 13% after they reported. And it fell 5% by the time the market opened. So it reported early Wednesday before the market opened, and it popped 13%. And they had a conference call. I mean, nailed every number, blew out earnings, right? Everything, just firing all cylinders. But you're looking at a stock that was $16 not too long ago, and it went to over 30. Yeah, people might take a little profits. Use that big event to say, hey, you know what? I bought into this a while. This is something that I was pitching. I love Twitter in 16, 17, 18. Many times I mentioned on this podcast. Not that I'm right all the time. I mention my losers as well. You were buying that earlier. Hey, this is a big liquidity event, right? The stock's up 13%. All this volume comes in. If you're a big institution, it makes sense. Hey, you know what? Let me take some off the table. Since when I look at the macro part of it, if you're a top-down investor, listen, most technology is getting killed right now. It's starting to get smoked. So this is a good opportunity. I get it. It's normal. If I look to go back into Twitter, finals to actually double-digit user growth, right? So they're getting more users, average users per day or per month. A metric that crushed them for so long. It wasn't the money. It wasn't the profits. They found a way to generate money the whole time. You look at their earnings over the past few quarters, past few years, rising tremendously. But earnings aren't the only thing that drives stocks, especially social media. You want to see those numbers and amount of users continue to uptick. And that's where, when they start coming to flat, that's where Twitter got nailed. Remember all the comments on Dorsey? Fire him. He's running 2 companies and he's terrible. Got to get rid of that guy. I love the people that actually say that run nothing. They don't run their own business. They're just an analyst. Got to get rid of that guy. He's running 2 companies. Crazy. He's not going to do it. Terrible. That and Square, horrible companies. Yeah, right. Guy's doing just fine. But when you're looking at this, when you're looking at these names, this is what you should be thinking at during these times, not panicking at a 3% number that's kind of common. Because a couple of people warned you about it for like a couple months. If this happens, be careful. Y2K, if it happens, be careful. The whole world gets crazy. And there was a time where the financial media programs, they used to be educational. There was a time where anchors used to ask questions and let the experts answer. Remember that? That was a lot of fun. Every anchor is suddenly a market guru, a specialist, an expert. They talk more than they put a guest on. Poor guy's on for 2 minutes, and the anchor's talking for a minute and a half. You're looking at these stories and just being hyped up. It's the end of the world. I mean, you see it all the time. Use it to your advantage. And when I see my mother walking into my office saying, hey, I'm worried about the market. Should I worry about the 10-year being more than 3%? She actually said that. And I asked her about it. You know what the 10-year is? She's like, no, but I heard that it's really bad for stocks. You know what? For me, it's kind of a time to probably start buying. At least buying stocks that are down 10, 15% over the past few weeks. Now, it is earnings season. Don't try to be a hero. Most companies crushing it. We even saw Alphabet, right, which is Google. Great numbers. They're spending more. I love when stocks get crushed that they're spending more money. You want Google to spend a fortune. You want Facebook to spend a fortune. These are companies that just generate a fortune off the money that they spend. And I love when those stocks get hit because of that reason. Even though they blew out earnings, and yes, cost per click's a little bit higher. Look at the quarter. Still a great number. But with earnings season, the trend that we're seeing is companies are crushing it, and they're seeing their stocks decline. So there's no upside in trying to buy your favorite stock ahead of earnings. Because chances are, even if they report a strong quarter, it's going to see a little bit of a pullback. And if they miss, look out. That's going to be a minimum 10% decline in this market, maybe more. So be patient. Don't buy a bunker. If you do, be sure to use my promo code that I gave you to save you 10%. But seriously, be patient. Look at names that are trading cheaper than the overall market, which is around 17 times, 16 times earnings, around there. Also look at those companies. Are they growing earnings at least in the double digits, which is most companies. On average, they're growing 17, 18% right now. And make sure they're growing sales. On average, they're growing around 7%. That's a good place to start. And I can tell you, there's actually a lot of large cap, really good names that fit that profile, that are trading at cheap valuations because they just fell 10, 15, 20% from their highs. They're reporting good numbers. Their earnings are solid. Their sales are solid. And they're buying back stock. Plus, they're paying an above average dividend of more than 2%. That's where I'd be looking right now. And don't take full positions in these names. Again, it's turbulent market. It's pretty crazy, a lot of volatility, but scale into some of these names, especially in the energy industry. Start scaling into a lot of these names. The growth is incredible right there. The oil above 60 is amazing. It's pushing 70. Yeah, we got some weekly numbers for oil. Those just came out yesterday. Yeah, that's a weekly thing, or of a trader thing. I see oil prices continue to rise. These guys are printing like crazy. These stocks are still down tremendously. They haven't participated in the move in the market higher over the past 12 months. That's a place I'd start looking. A lot of areas of the market where you can find deals right now. Stocks that are cheap. That's what you want to do. Scale in to these names. Don't take a full position. And you're going to be getting in at really, really good prices. And that's a strategy. And that's how you should be thinking about this market. Instead of watching TV and seeing a number that hits and the whole entire world is worried about it, you're probably going to see a nice bounce back. Remember, with all this nonsense, all the craziness, all your worries about the 10-year hitting 3%, the market fell 2% on this news. So again, the daily shows that have to create more and more news. Is it a big deal? I don't think it's too big of a deal. Is it something worth watching? Absolutely. Because 3.5 higher, got something to worry about. But the difference between 2.93, 2.956, and 3, I mean, in terms of the whole entire market selling off and everybody runs to exits, it's kind of ridiculous. So don't panic. Be smart here. That's the way I would play this market. Now, 10-year is a big story out there. You all know. So what I'm going to do for you today, I'm bringing on an amazing economist. Her name is Danielle DiMartino Booth. And Danielle used to work for the Federal Reserve, was an advisor to Richard Fisher at the Federal Reserve Bank of Dallas, which means she's a big shot. She's author of the incredible book called Fed Up, an insider's take on why the Federal Reserve is bad for America. Pretty cool. Someone that worked for the Fed that actually says the Fed is bad for America. She's a person that doesn't hold back. She's a guest on Mike Alkin's podcast, Talking Stocks Over a Beer, a few months ago. Mike introduced me to her. We've been talking ever since and just having really great conversations that I thought would be great to put in front of you and say, you know what, why don't you come on my podcast? I know you was on Mike's podcast last month, but it's a lot of different topics we're going to be talking about. So if you listen to that, I don't think it's going to be the same thing. Danielle is feisty. She's good. She has her own newsletter now called Money Strong. I thought she'd be a great guest to help explain what higher yields means for individual investors, mom and pop, and why even bottom-up stock pickers should be paying close attention to the economy right now, since it could lead to a lot of new ideas. Then in my educational segment, I'm going to give something very special away. And it's a lesson, more like a play-by-play on how I find some of my best ideas. It's original, something you got to read in any textbook, all those wonderful trading seminars that you watch on TV sometimes where that guy says, yeah, I turned $6 into $65 million, and all you have to do is buy here and sell here. No, it's not going to be that, I promise. You can make a $2,000 profit. All you have to do is pay me $5,000. No, it's not that. Real analysis, no BS. Almost anyone could do it to find new ideas. So you definitely don't want to miss it. And speaking of new ideas, Danielle is about to share things about the Fed not going to read anywhere else. She has strong opinions about the current state of the economy, what higher interest rates means for both bonds and stocks over the short and long term. Let's get to that interview right now. Danielle, thanks so much for coming on the podcast.
It's great to be here.
Well, we've been talking a lot over the past couple of weeks, and I'm going to jump right in here because you wrote an amazing book called Fed Up. This was last year, which is an insider's take on the Fed since you spent, I believe it was 9 years as an advisor to Richard Fisher at the Federal Reserve Bank of Dallas. And it was interesting because you said you were basically surprised at the decisions being made from people, which basically, right, literally impact trillions of dollars worldwide at the Fed without understanding of what's going on in the real world. And it sounded like you were really surprised because most of these economists at the Fed, you know, they had PhDs and they had very little business experience. Is this really how it is there? I mean, I'm curious to get the inside scoop of what goes on.
Yeah, you know, it was really it was surprising, but not in a good way. When I started, if you can imagine when I started, this was late 2006. Okay, so home prices had already rolled over on a national level, and there were already subprime mortgage companies that were blowing up, and there were already signs that there was outright fraud occurring in the mortgage industry. And judging from my reception and the fact that I thought maybe that the world might be about to catch on fire, you'd have thought that I was the crazy one and that they were perfectly rational.
Now, you were one of the people that actually saw that credit crisis coming. You saw the housing bubble and things like that. I mean, what were some of the things you saw, and what were you surprised that there wasn't a reaction here? Because I mean, you're mentioning it now, but it seemed even through 2008, right? I mean, we were still tightening rates, I believe, right? I mean, during this time before we said, okay, wait a minute, it seems like they weren't listening to anything out there, and they were very late to the party here. Why was this something that you could see, and a lot of people who were supposed to be the smartest people in the room weren't able to see?
Well, you know, one of the titles of one of the chapters, one of the first chapters in the book is called Group Think, as opposed to group think. And it's like group think on steroids. And that is really what I encountered internally. You know, Bernanke would get up in front of Congress and say that the subprime situation would be contained, and everybody would be like, well, that's what the boss says. So that's the reality of it. And there was never, it was never my intention to be disrespectful of Bernanke's brilliance. But by the same token, I was kind of like, well, you know, there are foreclosures that seem to be exploding in our midst, in our backyard. Even in Dallas, Texas, where I was at the time, foreclosures were going through the roof. And I'm like, and this is not anywhere near the Sand States, which was subprime central. So yeah, it was a very surreal environment, and I had, if on Wall Street, which is where I had come from, you saw a deal that really stank to the high heavens, you might say something, or at least you'd prevent your clients from investing in it. And yet these people just took it on blind faith that what the boss said was how it was. There were a few that questioned, but way too few versus the majority of people who thought the same thing. Bernanke said that home prices haven't since the Great Depression on a national basis, and therefore they will not.
Now, when we fast forward, right, we know all the stimulus. We don't have to cover all that. I'm sure everybody knows by now. And just, that big punch bowl being there for everybody. And now we're seeing a market where it's kind of being taken away. What are your thoughts on were those the right measures? Because, people have argued about deficits. Deficits are going higher and higher. And right now, I mean, it seems like we don't have any concern for deficits at all, at least from my seat. And I think you believe the same thing. And you could argue, and I'm not saying this, but they really didn't matter if you look at the stock market, if you look at what the economy is doing now, but it is going to matter one day, right? I mean, what are your thoughts right now where it felt like for me, and you're the economist, and feel free to say, Frank, you're an idiot, I have no idea what you're talking about. But I just felt like they should have been raising rates 2-3 years ago, even further, as this economy seemed like it was picking up steam compared to very late now. I mean, is it safe to say that? I'm curious to hear your thoughts on it.
Oh, absolutely. Look, we all remember, us market veterans remember good and well the taper tantrum that started in 2013 and culminated with the 10-year benchmark Treasury yield going over 3%. Something that has just now recurred over 4 years later. At the time, there were plenty of people on the inside. Richard Fisher, Jeremy Stein, Jay Powell was among them. But also Charlie Evans, and Charlie Evans was the ultimate dove, Charlie. But the head of the Philadelphia Fed, his name escapes me right now. But there were plenty of people who were rational and saying, we don't need to be talking about a taper right now. We need to just rip off the Band-Aid because the bond market has acclimated to the idea that we're no longer going to be the biggest force in the market and start raising interest rates. We don't have to take things at glacial pace. And yet, if you look back at the history of the Federal Reserve, 104 plus years of history, you will see one thing. What we have just witnessed beginning in December 2015 is the slowest pace tightening campaign in the history of the Federal Reserve. And I think that markets are as sanguine as they are because the current tightening campaign makes Greenspan look like he was an Uber hawk. Because you remember when he used to raise interest rates 25 basis points at every meeting, and it just kind of looked like a stair step in the years leading up to the housing bubble popping. Well, this has been an even slower pace, but starting points matter. The 2-year Treasury yield has doubled. LIBOR has gone through the roof. Companies' interest expense has increased, and inflation is a very phenomenon. But I think that markets have been lulled into a sense of such comfort that they are akin to that proverbial frog who does not realize that the water is heating up slowly, but at some point it will come to a boil.
Yeah, and I guess the big question is when will that happen? Because when you look at housing prices today, what do you think? Because, with this podcast, I'm fortunate where it has a big following, and there's a lot of brilliant people that listen to this, and I have a lot of real estate agents. So I'm a data guy, right? It's not that I'm perma bull, perma bear. I let the data do the talking. I see no supply in the market. I have a lot of real estate agents as friends. They can't even get houses to sell because there's nothing on the market. As soon as it comes out, they're immediately selling it. But what do you see now, and how will interest rates play with that? Because that's, one of the risks people are talking about. Again, we'll get to the 3%, right? The line in the sand. As soon as it hits 3%, we're seeing the market come down. Everybody getting nervous. It's been on CNBC every second. But what is your thoughts on the housing market as someone who saw the risk coming and predicted that compared to right now? Should we be worried? Do you still think we have some time? Is it a bubble inflating? What do you think?
Well, a buddy of mine who happens to be a raging bull typically sent me a picture recently, and he said, "What is wrong with this picture, Danielle? What am I missing? Why has home ownership not rebounded, even as home prices certainly have. What am I missing here? The St. Louis Fed, of all places, called it a housing recovery without homeowners. It's not that some of the news that we're seeing on housing is not hopeful. It is that we have literally gutted an entire generation of home buyers, and the implications for the baby boomers cannot be understated. If you have an entire generation of millennials who have missed the window, a natural window that they would have stepped into had they not had all those student loans, had wage inflation and higher than what it was, had wage inflation not really been stagnant, then they right now, Frank, would be popping out their second kid. And they would be looking to their move-up home. And move-up home buyers would be looking to buy baby boomers' homes, McMansions. Well, we have a huge gulf in between the millennials and the baby boomers' McMansions, and prices are prohibitively high. You see that first-time home buyers remain under a third of buyers and have for the entirety of the housing recovery, and median home prices are through the roof. The majority of new homes being constructed and sold are north of $500,000. That's not going to help out a millennial. So my greatest concern is that we have seen a full rebound in home prices, but we've not seen anything like a full rebound in what natural homeownership should be among those in the largest generation in the United States right now, the millennials.
Yeah, I know, millennials. It's funny how you say you should be ready to pop out your first kid. You haven't lived in Florida because usually that happens when they're 18 here. I'm still getting used to it. But where we grew up, right? Well, you can't do that because it's very expensive to live in some of these areas. And I mean, my wife and I waited till we're 30 because you can't afford it. Both of you have to work for a long time and save up money. Where it's a little bit different in Florida. I guess that the cost of living is cheaper, but. So what is your take on millennials, I guess, and we'll stay here because it's such an important part, right? I mean, this is the next group, and I think now I think I read somewhere that that's a bigger group than the baby boomers. I could be wrong on that. But this is a group that is heavily in debt, right? Student loans, they were told if they took out student loans, they'd make a lot of money, and now they're not getting those jobs to pay off those loans. How is this going to affect the economy to the point where when do they become the prime people in the economy where it's going to make a difference? Is this something that we have to worry about 10 years from now, or are we seeing it right now, especially, and you bring up, which we'll talk about in your newsletter in a second, the unemployment of millennials, right?
Oh, absolutely. But this is something that we have to worry about. And you can throw a tomato at me, but it's not going to hit me. I'm too far away from you. This is something that will come to a head just as soon as the markets fall out of bed. It's as simple as that. Mainly because the baby boomers don't have wiggle room to withstand another body blow to their retirement portfolios. And a lot of them will at some point, because they are truly aging a lot. You read all the time about baby boomers going back into the workforce. But now they're hitting their 70s, and a lot of them aren't going to be able to work. A lot of them are going to turn to their homes to sell them. And who's going to be there to buy them?
It really is a crazy situation. It's getting worse. Yeah.
Baby boomers' net worth is tied up in their home in a lot of cases. And the next time the markets set back, and I do believe that the markets will have a setback. I mean, I don't think that we have rescinded the laws of gravity. And I don't think that the volatility in the markets in 2018 is a figment of our collective imagination. I think that these are very real rumblings as the storm moves on shore. So it's fair to say that the baby boomers aren't going to have enough time in the stock market to recoup their losses as they've had the opportunity to do over the last 9-year bull market run. But again, we still have underemployed millennials and millions of them.
Yeah, I know you brought up a percentage living actually at their parents' home still that are over 20 years old or whatever. It is a crazy situation. A lot of millennials listen to the podcast, and I'm aware of it even through them as well. Once again, we're talking to Danielle DiMartino Booth, author of the book Fed Up, Insider's Take on Why the Federal Reserve is Bad for America. Guys, seriously, I don't endorse books a lot, but this was a fantastic book, so definitely give it a read. And I was introduced to you from Michael Alkin, who works at Curzio Research, has his own newsletter. And what I love about this and talking to you and talking to Michael, because now we're seeing the Wall Street crowd, and there's so many brilliant people, right? When people hear Wall Street, they think it's terrible things. But really, most people are really good and do the right thing on Wall Street. You just hear about the bad people. And the point I'm getting to here is it's amazing how many people are coming out of that to write newsletters like Alkin, and we hired another guy, Barry Cohen, who's in the hedge fund industry for 20 years. And now we have you who is writing a newsletter. So why don't you talk a little bit about your newsletter, which is pretty cool.
Well, my newsletter is actually, it's just me being lazy after leaving the Fed. But what can I tell you? I was in a bureaucracy for years. I got fat and lazy. No, I'm kidding.
It's not lazy, guys. It's not late. It's a great newsletter. It's a lot of work into it.
But it is the position that Richard Fisher created for me was so unique, and it was such a great opportunity to effectively be his eyes and ears on the markets, on every aspect of the financial markets, whether you're talking about private equity, whether you're talking about commercial real estate, the bond market, the stock market, the earnings season, you name it. I was tasked with rooting out any areas of growing risk in the market. That was my job. And it was such a joy to produce this briefing in front of every Federal Open Market Committee meeting that when I left after having done this for 8 times a year and writing a policy recommendation before he went off to Washington, having done that for so long, I realized that it was my life's calling. I was just going to start doing it for the public. And so the breadth of information that I cover, because I became intimately familiar with the field of economics while inside the Federal Reserve, which I sure do hope that I did. I hope Powell has as well, even though he's not a trained economist. And I always knew the financial markets. I came off of Wall Street, and now I have this treasure trove of information on the inner workings of the central bank, the biggest central bank in the world. Why wouldn't I share that unique bit of information, that unique perspective with potential investors? Because these days it matters. All perspectives matter.
Yeah, it is a good point. And look, I love economics, and we talked about you at the Fed when it comes to economists. But for me, when I look at economics, and again, most people really don't like it. I love it. I know you love it. It's for me, it was never bell curves. You can look at historical analysis and stuff like that. We always look at the numbers, but the economy, for everyone listening to this, is everything around you. It's like when you go into the malls, there's a crowd. Are people actually buying stuff? They're carrying bags. Are there homes being built in your neighborhood? Are prices rising or falling? When you go to supermarkets, price of milk, cheese, water, bottle, whatever, going higher, lower. You fill up your car, gas, whatever. What are your friends doing? Borrowing more money for the new car. I mean, everything around you impacts the economy. And the point I'm getting here is the average person out there, if they open their eyes and just pay the slightest attention, I think they could have a good gauge on the economy. Now, from your experience and outside the Fed, say with some of the economists that you do know with all the experience, you've been in this industry for a while, do they always just look at the regular indicators, or are they really looking at the real world stuff? Again, we talk about that with the Fed, but what about the average economist? Because what I see and what the forecast I see for economists is very rare. It's very rare for them to have their finger on the pulse, at least from what I'm seeing.
Well, and again, look at Alan Greenspan's reaction to a warning in 2003 from one of his chief lieutenants that, this subprime thing is really opening the gates to homeowners who've never ever qualified for a mortgage. Do you see anything wrong with this picture? And Greenspan's answer to him was, all of this non-prime lending is occurring outside of the 25% of mortgage lenders that the Fed technically regulates. Ergo, go away, leave my office. So he chose to look the other way, turn a blind eye to something that was going to affect the entire economy. Now you see people driving all manner of new cars. And I know, and you know, that the size of new car loans is at a record high, and that the maturity of car loans is also a record right now, and that there are a lot of people out there driving more car than they can afford to drive. And yet you hear from most central banking types that this is not going to be a problem because it's only affected a tiny sliver of households. Well, guess what? Those are a lot of the same households who are still smarting from having their homes repossessed. So they've decided the best thing that they can ever hold on to is a set of reliable wheels to get back and forth from their overpriced rental to work. So again, to me, they haven't noticed too many things that are in our face. It's true that there's a ton of consumption going on out there, but mobility has not improved from the worst levels since World War II. Mobility. There are still as many millennials living in their parents' basements as there were when at the depths of the housing crisis, and they've been unable to move out because Fed policy has encouraged luxury apartment construction and luxury home construction, because that's all that works in a zero interest rate environment. So now there's no place for these kids to go. And by the way, they're not kids anymore. They're 35 years old. So it's not that millennials don't have the newest iPhone and that they're not driving a BMW. It's that they're still living in their parents' damn basement. And this should be visible to your average central banker. And yet it isn't. I'll add one more little anecdote. I follow Challenger, Gray, and Christmas layoff data. I have for years. I've known John Challenger since he founded the survey. I've known John Challenger since he started tracking hirings. I promise you right now that there are very few people inside the Fed who can tell you that last month, hirings versus last year for the first quarter declined from 300,000 to 200,000, and that is not a good sign. But
so speaking,
the Challenger data was something I was told to disregard because you couldn't seasonally adjust it. That's a real world example.
Wow, yeah, it is incredible. I like that survey too. Yeah, no, I hear about it too from economists. Well, you should disregard that and disregard. It's kind of funny when a lot of the unemployment reports and all these numbers are reported. And all these guys jump on TV at the same time. They got like 10 windows and stuff like that. They analyze the data within 1 minute. But anyway, I want to go back to what you said earlier, where you're saying, millennials, a lot of this stuff's going to come to a head. How important right now, and this is a question I guess everybody wants to know, is the 10-year hitting 3%. I mean, how big of a deal that is, where for me, when I look at it, is there really a difference between 2.97, 2.98, and all of a sudden 3%? It was a line in the sand and the market fell 500 points. Again, I don't want to get too much into stocks and stuff like that, but how big of this is a deal? And if it's not that much big of a deal, what should we worry about? Because when we look at the 10-year, we saw that, the 10 years prior to the crisis, it averaged 4.5% and was so worried about 3%. Why should we be so worried about 3%, or should we be at all?
Well, I think that 3% was a line in the sand that tripped a lot of algorithms. It is a psychological level. The level itself simply reflects a slow march upwards that we've seen in yields now for well over a year. So it shouldn't necessarily mean anything. The question becomes one of, though, what happens as the monthly interest expense of the country begins to be reported and these numbers start to rise at a very quick pace. For now, I think the markets are taking it in stride. I've been telling my readers that what they need to pay closest attention to is not the VIX, but the move. And we have not seen complacency we've not seen the death of complacency in the debt market. Right now, we've got high yield spread differential that companies pay over a comparable maturity Treasury at the lowest since 2007, at the lowest of the cycle. In other words, the bond market is wide open. And as long as that is the case, I think markets will take the rise in interest rates in stride. But once we see more bond deals, and you see this mad rush of companies. We had WeWork come to market for the first time recently. We had Netflix with $1.5 billion. We had Tesla. You're seeing companies rush to the market and price paper as quickly as they can and as much as they can. My greatest concern is, as we're seeing profit margins compress, that this might be the peak earnings season, and that corporate America might start to choke on higher input costs, on higher labor costs, at the same time that they have to go to market to refinance their bonds.
And it makes sense. I might disagree with you maybe a few months ago, but after listening to conference calls, I mean, a lot of the CEOs are talking about higher input costs, higher inflation and commodity costs and stuff like that. I think that caught the market by surprise as well, where they're actually seeing it already. And, we're being told right now, inflation's rising gradually. It's a little bit. But to hear it from that many people, I was just surprised so far during earnings season. And we're probably not even halfway through earnings season yet.
No, I mean, at first it was General Mills, and they were like, oh, that's an idiosyncratic situation. It was just their cardboard, blah, blah, blah. Well, and, within one day, then we hear Kimberly-Clark, Caterpillar, and 3M. 3M got smoked. Again, these input costs are very real. My husband works in industrial packaging, and he's seen 3M push through 3 price hikes in the space of a few months. A 30-year veteran of the packaging industry, never seen anything this rapid. So my concern is that, Monday we get the core PCE, which is the Fed's preferred inflation metric. On May the 9th, we get the next CPI report. And my concern is that Jay Powell at the Fed is going to chase this inflation and push up interest rates more than the markets are anticipating. And that will be much worse for the markets than the 10-year benchmark yield hitting 3%.
No, that's a very, very good point. Now, I'm going to ask you a question you probably never get asked before. You're talking about stocks. It sounds like you're listening to conference calls and seeing exactly how that you have your finger on the pulse. Do you personally invest on this like as a top-down approach because you have a great feel for the markets of where we're heading on economic levels, probably different industries and input costs and stuff like that, which leads to a lot of good investments, not even in industries, but filtering it down to different stocks. Do you invest in some of these things? I mean, am I going to get an idea out of you? It's kind of like, you just back on the bigger level and just listen to some of these big guys on these conference calls.
Well, look, I do not have any money in the stock market. I'm going to answer your question as plainly as I possibly can. I have seen where we are today, and I know how it ends. The final chapter of a market's last hurrah typically is when correlations begin to line up. And we've already begun to see that. And that usually signals that we're going to throw out the baby with the bathwater and that all stocks are going to get hit when markets come down. That is not to say that the leaders in the stock market, but the concentration in the stock market is not such that there would be great buying opportunities earlier on, well before markets bottom. So that I will put out there. Because if you look at the differentiation between valuations, it's day and night for a lot of companies. Some companies have stronger balance sheets and greater cash flow than others, and there will be buying opportunities in those sectors in the months and the years to come.
No, you're definitely right about the disconnects in the valuations. I mean, this you see 16, 17 P and the S&P, but there's some that are trading 40, 50 times, and you see some trading 13, 12 times. There's a big difference. Bigger than I've seen in a very long time, which may lead to more ideas and things like that for people. But before we go here, I want you to tell the audience and my listeners if they want to find out more information about you and your amazing newsletter. And I love the fact that you write a newsletter now, which is Money Strong. It's a weekly newsletter that you write, right?
Yeah, I've not skipped a week. I've not skipped a beat since I left the Fed in June of 2015. I've published every single week. My husband just loves that I publish, regardless of where we might or might not be on vacation. But it is my passion. Follow me on Twitter at DiMartino Booth, DiMartinoBooth, and that's also my website. Come to a trial subscription if you'd like. You get a 30-day look back. But more importantly than anything else, don't let me convince you. Fork over $20, buy Set Up, read it, and you won't need to know anything else. Then you'll want to read what else I have to write.
Nah, that's great stuff. Well, Danielle, listen, I really appreciate you taking the time. And now how busy you are, you're always traveling, and I know my audience really appreciates that you took the time to come to the podcast.
The pleasure was all mine, Frank. I appreciate your time.
All right, great stuff from Danielle. I love having economists on. Sometimes it doesn't always go well because I know people love their stock picks and individual picks, but I really enjoyed the interview. I thought it was awesome. I think she's great. But this podcast is about you. It's not about me. So let me know what you thought at frank@CurzioResearch.com. That's frank@CurzioResearch.com. Again, when I'm talking to people, I think, I'm always thinking of you guys and say, what's interesting? What do you need to know? I know 3% on the 10-year is such a big story, and, I just wanted to bring someone on, but we want to make sure that it's entertaining and fun and educational and stuff like that. And I really like that interview. But again, like I said, it's about you, not about me. So I always want to hear your comments, whether they're critical, whether, whatever it is, frank@CurzioResearch.com. Now let's move on. Get to my educational segment, which is about finding new ideas. In fact, it should be every investor's goal, right? And trying to find these new ideas before the public knows about them. And I'm not talking about insider trading here. There's tons of stories out there that most of Wall Street, you have the media, they really don't catch on, especially early on in these trends until the industry or the stocks within those industries really run up tremendously. Then they get on everybody's radar. I mean, you're not seeing IBD recommend anything that's down 60% or a new thing that just, they always like these uptrends. And sometimes it takes a while to build these things. I mean, early on, nobody really knew what big data was. Nobody knew what fracking was in 2010. Cloud, VMware was the big name like 10, 12 years ago. I mean, but it's just starting now. It's AI. You want to get into a lot of these trends before people really start talking about it, because that's how you can make the biggest gain. Because as you bring on more attention to the Netflix and the Facebook and things like that, I don't know if you can bring any more attention to Facebook before it went public, but I think you know what I mean. But once they get on these medias and they get the IBDs, Wall Street journals, you see so much more interest. Institutional money starts pouring into these things. It's nice to get into some of these things early. Now, how do you do that? It's not easy. And I could tell you something. It's not always about finding the new trend, right? It could be about an industry that's completely out of favor that everybody hates. Like oil 6 months ago, technology in 2004. Remember when banks were hated? I mean, we're talking 2 years ago. JP Morgan trading under 60. It's over 100. Yeah, it's 2 years. What about the airlines? Remember how hated the airlines were? Buffett, I'd never buy an airline. It's the worst. Want to lose money, buy an airline. Remember, now he's one of their biggest supporters, owning a huge stake in several of the majors. So things change within each industry, and the ways you make the biggest returns is buying something that's really out of favor. Yes, sometimes you could buy the Netflixes, you could buy the FANG names on those momentum, and you can get like big gains. But life-changing gains usually come when you're really early to something, because it's so depressed and out of favor that even when these things go from bad to less bad, you're going to see 100% move. I mean, sometimes you'll find stocks that are trading at 50 or 60 that are trading at 10. And then the trend starts to turn a little bit, and those things go to 20 like nothing. And they go to 25. Then you got the technical analysts saying, wow, they're breaking out, and things are going great. Now they get the attention. All of a sudden, next thing you know, you have 300, 400%. And you got idiots on TV saying, this stock's a buy when you bought it at 10 and it's now 40 and, whatever. You guys get the point. So where am I getting at with all this? In order to find those good ideas, you have to be a contrarian. And that's a word that's thrown around a lot, right? I mean, we hear so many people, I'm a contrarian. We hear all the time, right? They say it. They say it all the time. I'm a contrarian. That's the way, just like, a lot of people say they didn't vote for Donald Trump, right? Everybody says that. Nobody voted for Donald Trump. No, 63 million people voted for him, right? That are living in the U.S. But nobody voted for Donald Trump. But being a contrarian, or if you want to know if you're a contrarian, it has to make you uncomfortable. And when you're presenting an idea and people are reading your research in front of you, or the people you're pitching that idea to, you want them to be shaking their head in disbelief that you would actually talk about such a thing. You almost need to doubt yourself. Like, holy, I won't say it. Am I making an idiot myself talking about this? You have to be uncomfortable. It's almost like a 400-pound person taking their shirt off on the set of Baywatch, right? Very, very uncomfortable. That's how you have to feel. That's how you know when you're being a contrarian. Now, one sector I like since October is department store retailers. And people thought I was crazy. I actually thought I might have been a little nuts for a minute or two. We all know Amazon, right? Putting every one of these companies out of business. The malls they operate in are dead. Just burn them. The insurance money you get will be far greater than the sales profits that they're probably going to generate, over the next 3 to 5 years, right? That's how bad it was, right? It's gone. It's crazy. It's nuts. But for me, when I was digging deeper, I realized that a lot of these companies are down 70% plus. They weren't going out of business, right? They're finally making progress adapting to e-commerce. That's what it is, right? You have to adapt to this market, right? So they're doing online to in-store purchases. They're using big data analytics now to control inventory, which is a major concern for them. At every holiday season, it was crazy. They have people in person that educating their employees, that answer your questions as, you would go in and actually sample these products, right? So in person, what you like to do. So to me, it was no surprise most department stores, big box retailers, they had an amazing holiday season. And we saw a big bump from pretty much October, November. Yeah, think about it. The moves in Macy's, the moves in Kohl's, the moves, even Target has gone up tremendously, which caught me by surprise. One of the ones I didn't like. JCPenney came back a little bit. So when I see all these companies really coming back, it just made sense to me. Now, where are we today? It's still a depressed industry, and people are still talking how bad it is. That was an interesting story last week. That was a game changer, in my opinion. I mean, it's absolutely fantastic. It's totally under the radar. And no, it wasn't like, the Jet, right? We got the trade. It's awesome with the NFL, right? The Jets trading away their last few picks for Cleveland to sign a quarterback or go crazy. Listen, it's not that, right? That wasn't the story. It wasn't crazy. It wasn't an AT&T deal. It wasn't nothing like that. This story was much more important, in my opinion, even if you're a New Yorker. So Jeff Bezos and Hubert Jolly signed an exclusive partnership between their company. Now, Bezos, CEO of Amazon, largest e-commerce retailer in America. Jolly's the CEO of Best Buy, the largest electronics big box retailer in America. And they signed a deal. So Best Buy is now going to become what? Like their exclusive big box sales channel. So they're going to sell flat screen TVs with Amazon's Fire TV streaming service. And these TVs are also going to be equipped with Alexa, voice assistant technology. Now, why was this such a big deal? Well, Amazon, as you know, sells almost every one of its products. You can find at big box retailers on its website. It can ship these products to what? To your home in 2 days, free if you're a Prime member. So every transaction on Amazon is obviously done online. And then what does that do? It eliminates the massive costs that big box retailers must pay, right? To operate these hundreds of stores, including employee wages, electricity, cleaning, equipment expenses, millions of dollars on leases, right? Something Amazon doesn't have to deal with. So what does that mean? Without those costs, Amazon could charge pretty much lower prices than its competitors. What happened in the market? Well, we see a lot of people going bankrupt, a lot of companies. We got Sports Authority, Radio Shacks, The Limited, Gymboree, Bon-Ton. Recently, Toys R Us. They were going to try to do bankruptcy, keep a couple of stores. Nobody wants to buy their stores. They said, okay, we're closing them all now. Right? There's a story like a couple of weeks ago. So most retailers believed big box stores and malls they operated were absolutely dead. We all saw the headlines, the fate of America's dying supercenters, the great retail apocalypse, the death of American Mall. Again, this is from the big outlets, Wall Street Journal, CNN, Business Insider, right? As you know, I've been arguing strongly against this, at least over the last 9 months. I know they were going to have trouble competing against Amazon, but they learned to adapt, matching prices, providing special in-store service, stuff like that. But what's interesting about this is Bezos actually met with Jolly in a Best Buy store. This is in Washington. And here's what he said. He was watched Best Buy for a long time. And the last 5 years since Hubert Jolly came to Best Buy have been remarkable. Because, the turnaround that got done there from just a business case study point of view is going to be written about and talked about for a long time. And then Bezos also added, we talk about the huge benefit of customers being able to try out new products in person. He goes, I'm quoting him here. People want to come in and see the TV. They want to experiment with the TV and try it out. The magnitude of those comments can't be understated. You have basically the CEO of the biggest e-commerce company in America, the company that was predicted to put every big box retailer out of business, is now saying he needs company like Best Buy to sell its products. If that's not the ultimate endorsement of this industry not going away, I don't know what is. So what does that mean? Where am I going here? Because when I look at this and I see big box retailers, they all get lumped in the same way. But yeah, if you look at Walmart, Target, Home Depot, Costco, TJX, Ulta Beauty, these companies are thriving. They're big box. It's not the whole industry. A lot of these names are trading at super depressed levels. Some are still down more than 60% from their all-time highs. Wall Street and the media still completely write off this industry. So for me, and I'm getting to the stock picking part, right? I'm just setting up the scenario for you. Big box retail, it's a good place to look for ideas. You're going to get companies that are dirt cheap. They're likely going to see strong earnings growth because they learn to adapt, right? It's not just because they figured out how to use e-commerce, finally, but they also went through massive restructurings, right? They're closing stores, firing employees, creating stores within the store. What does that mean? If you go into JCPenney, they have Sephora's and stuff. So they used to have space there of clothes for women that didn't sell. Now they're putting something like beauty salons in there inside the store. That increases your square footage, right? Per square footage. That increases the value in your stores. You're bringing in more traffic. They fired executives, have lower pay structures. You know what these things do? They significantly increase earnings. And as someone like me who's been in this industry for the past 20 years, most sell-side analysts, most, not some, most, do not see this earnings growth from restructuring. They don't put it in their estimates. They always underestimate it because they're usually super conservative, but yet these cost savings can amount to hundreds of millions of dollars. I mean, they could sometimes increase earnings by 15 to 20%, and they're not any analyst estimates. I see it all the time because when a company's restructuring, what does it mean? It means probably the stock's falling and they're not doing something right. So you're not going to have higher earnings on it. They're going to report lower earnings until they hit a bottom. And once they hit a bottom and business starts to turn around, those earnings get multiplied because their costs are much less because they cut back on so much stuff. So now you're going to see these earnings explode. They're not going to go 10, 15%. They're going to go 30, 40. There's a reason why earnings are exploding right now for energy companies. It was depressed. They cut out all that garbage, all that crap. Now oil prices shot up. They have half the employees to play. Now they'll build up. They'll start spending a little more here and there. But they're so lean, those earnings soar. And that's what people are missing with the oil industry. You're seeing these stocks go to the roof. And you're going to see it with department stores and big box stores. So for me, every day that I'm doing research, I'm looking through my search engines. I'm watching the news, screening for stocks. And I have retails in the back of my mind. So 2 weeks ago, I saw several insiders purchasing shares of their retail company. So it doesn't mean I'm going to run and buy the stock. No, it's like, oh, insiders, you got. No, there's much more to that. That's just a starting point. It means I want to do some more digging. So I look at the stock. It's down 40% over the past 12 months. Something I like to see. Insiders buying when the stock's down 40%. I like that. I do. It makes me feel like there's a bottom there. So I start digging even more and see the company fell alongside the rest of the industry from January through October 2017, which is normal. But why is the company still down? And they had two crazy events that pushed the stock down further. I'm not going to give anything away, but let's just say these are two events that will never happen again. Never happen again. One time. And that's probably why these insiders are purchasing the stock at these dirt cheap levels. Because every investor lost patience with the company. They went through that whole site. 2017, everybody got killed. I'm like, okay, I'll own it. And now all of a sudden you take another dip down. I'll just lose patience. I'm out of it. I can't take it anymore. I'm done. That's called puking. So then I start looking at the insider history. And there's several insiders that are buying, about 4 or 5 of them, buying big lots. But one insider, bought more than $40 million worth. That's a lot for a small cap company. So for me, I never heard of the guy. I start digging further. I found out that he's a billionaire and a legend in the retail industry. So the reason why I never heard of him, because most of his assets, along with his huge retail company, are based in Europe. Yet this guy's been sitting on the board of this company for the past couple of years. And he's one of the smartest retail investors. You just have to look at his track record, how he became a billionaire. So I start digging even further. I start seeing not only is this stock dirt cheap, because dirt cheap stocks get even more dirt cheap, right? You want to have catalysts. So not only I see a stock that's dirt cheap, insiders buying hand over fist, they have several huge catalysts coming up. Game changers for the company. Catalysts that you don't normally see. They're going to be launched over the next few months. Not only do we have the catalyst I mentioned earlier about restructuring, we have this company on the way down, restructuring, improving its balance sheet over 6 months. Restructuring operations that would definitely increase earnings, not just this year, but for years and probably a decade. If you're a Curzio Venture Opportunity member, you just got that stock pick last night. When you read my research, you're going to know why insiders are buying the crap out of it right now. And to be honest, I have no idea if the stock's going to go up or not. I don't have a crystal ball. And based on everything I know, been doing this for a long time, doing the homework, really doing a lot of research, I think we're easily going to see triple-digit gains on this. Easily. And I'm talking about over the next 12 to 18 months because it's so depressed. Not just insiders buying. They got great catalysts. They just reported a pretty decent quarter. But what I do know is the stock is trading pretty close to an almost risk price. I mean, it's already gotten destroyed. Based on the fundamentals, it's dirt cheap. They restructured operations, including their debt, where they're going to have no major maturities for 4 years. They're going to see earnings growing artificial just from cutting all those costs. And now I have the insiders who are filthy rich people buying the crap out of the stock here, which means if it does go lower, what's going to happen? These guys are rich. They're going to buy more. They're not into buy a million. I say this all the time when it comes to insiders. And they sell stocks for 20 different reasons. They only buy for one. These guys aren't looking to buy this stock to get a 15% gain. They're looking that the stock could easily double, go minimum 50%, 100%. And that's why they're buying at these levels. And based on where they've been buying, which was a little bit higher and the stock has come down a little bit more, they continue to buy. That tells me, you know what, we kind of have a bottom here. And if things go right, this stock could really go through the roof. Anyway, I know I'm getting a little long here, but this is how I follow ideas. I try to buy things that are cheap, which means they're probably, not probably, but they're out of favor. I don't do this all the time. You guys know I like buying growth and momentum names. I have Facebook. I've recommended Amazon and a lot of these growth names. But for me, I'm always on the hunt for new ideas. I'm familiar with the retail industry. I know it's depressed. And by seeing one small insider buy, it led me to his stock after doing tons of homework that I think is going to make a lot of money for my subscribers. So for me and this educational segment, I just wanted to go through that whole process, show you how long it takes to find a new idea. It's a process. You need to be patient. But you also have to be on the lookout at all times. That's more than just reading the Wall Street Journal or watching CNBC for an hour, but attending conferences, trying to visit companies, taking tours, subscribing to the right newsletters where the analyst basically has been around longer than 15 years. That means he lived through lots of ups and downs, recessions, inflation, deflationary conditions, someone with experience. But if you do the work and put yourself out there, you're in the room, you'll be rewarded. Trust me on that. Okay, guys, also be sure to check out my Curzio Research Facebook page. We just upgraded our technology where I could do live Facebook interviews now. We're going to start doing that pretty soon. Plus, we could post to numerous social media outlets. So you're not just going to see me on Facebook. You're going to see me on Twitter, lots of different things, Periscope, things like that. And more important, I could also bring up screens now when I'm talking. Right? Since we have, several cameras, you don't have to look at my ugly face the whole entire time during these videos, which is good news for you. So I could bring up a lot of free sites like, whether it's CNBC, FinViz, Yahoo Finance. I like to bring up free sites that you guys can follow along and show you, the different stories, the actual numbers, teach you how to read a balance sheet, income statement, go over what each metric means, like dividend payout ratios, if it's short ratios, tangible book value, insider ownership, why some of these metrics are really important for some stocks and kind of meaningless for others. Right? Same store sales are a big trend. That's more important than just earnings when it comes to retailers. If you look at social media companies, a lot of times it's not about earnings. It's about monthly average user growth. So there's different metrics that are much more important, and it's easy to cover now that I can put these screens up while I'm talking. So all that technology is available, really cool stuff, all for free on our Curzio Research Facebook page. So guys, be sure to check it out. A lot of fun, put a lot of work into it, and we're getting really, really good feedback. So guys, that's it for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.